For 60 years, the Organization of the Petroleum Exporting Countries has operated as one of the most effective financial syndicates in modern history. By capping how much crude its members extract, the bloc reliably engineers supply to keep prices elevated. But a brutal conflict in Iran is putting severe stress on the physical infrastructure that makes that control possible. The Strait of Hormuz, a geographic choke point responsible for a fifth of the world's crude oil and natural gas, is effectively shut down due to threats and attacks on shipping lanes. Looking at this map of the Middle East reveals the immediate fallout. The blockage at the strait creates an instant bottleneck of 14.5 million barrels of oil per day, cutting off massive volumes from the global supply chain. Stripping that much crude from the market at once forces the remaining members into a corner. They cannot easily replace those missing barrels, which has triggered widespread panic across global exchanges. This chart tracks the violent reaction across major energy benchmarks. With millions of barrels sidelined, West Texas Intermediate crude broke the $100 resistance level, while Brent crude spiked to $119.50. Simultaneously, the average U.S. gasoline price pushed past $4.18. As a result, Wall Street analysts are sharply divided on the fallout. Goldman Sachs expects a persistent but contained supply shock, forecasting $90 for Brent crude. Citi, however, warns the blockage could push Brent to $150 a barrel. Yet the immediate price spikes are obscuring a structural shift taking place inside the market's governing body. The United Arab Emirates, historically the third largest oil producer within the bloc, has officially walked out of the alliance. The UAE's departure shifts the crisis from a logistics problem in the strait to a structural failure inside the organization itself, casting doubt on the cartel's future ability to coordinate as a single unit. The friction leading to this exit stems from internal financial strategy. For years, Abu Dhabi poured capital into expanding its domestic oil production capacity, preparing to pump significantly more crude. But OPEC's group quotas forced the UAE to keep that new capacity offline. The rules prevented them from actually generating revenue from the massive infrastructure investments they had already built. The situation hit a breaking point over regional security. The UAE leadership expressed fierce frustration with the Gulf Cooperation Council, citing a weak political and military response from neighboring countries as Iranian attacks escalated in the Gulf. Unwilling to accept constrained profits and limited security support, the UAE dropped its role as a quiet team player. They took their 2.9 million barrels a day of production and left the table. This sudden exit represents a calculated rebellion. The UAE is abandoning a system that limits its financial upside and fails to protect its strategic interests in the region. To understand the quantitative damage this causes to the alliance, look at this breakdown of total OPEC production capacity. The moment the UAE leaves, a 15% slice of the group's total output power vanishes. Beyond the sheer volume, the group is losing one of its most compliant members. The internal trust required to coordinate deep production cuts is severely damaged. This sudden drop in shared capacity isolates Saudi Arabia, leaving Riyadh at the top of an increasingly fragile hierarchy. Without the UAE's volume to help balance the scales, Saudi Arabia faces the logistical burden of enforcing quotas and managing global supply almost entirely on its own. The mechanical levers the cartel relied on for decades are under immense pressure. Without the UAE's market share, the remaining members simply lack the leverage required to reliably dictate global energy prices. As the alliance fractures, the primary beneficiary of this Middle Eastern rift is the United States. President Donald Trump has consistently criticized the cartel, arguing their coordinated production caps artificially inflate prices. The UAE's exit provides the first major piece of evidence that the bloc's internal unity is failing. By severing its ties to OPEC's quota system, the UAE gains the flexibility to rethink its regional partnerships. This opens the door for much closer bilateral coordination with Washington on global energy strategy. A divided cartel means a significant reduction in coordinated price manipulation, shifting leverage away from Middle Eastern oil producers and directly benefiting American economic interests. The rift turns a regional security dispute into a strategic opening for Washington, allowing the U.S. to negotiate with individual producers rather than a unified bloc. This leaves the market caught in a massive tug-of-war. The immediate threat of violence in the Persian Gulf is driving prices into the triple digits, but the long-term math points in the opposite direction. The UAE left the alliance for one specific reason: it wants the freedom to pump more oil. A weaker OPEC, stripped of its ability to strictly enforce production limits across the region, results in a future with far less price fixing. If Saudi Arabia continues to lose its grip on regional output, the UAE's push to maximize its massive reserves could flood the market, creating a substantial global supply glut and driving oil prices lower. Which force wins out depends on the timing, whether the immediate supply squeeze pushes oil to $150, or if a fractured, disunified OPEC eventually loses its ability to keep the market from being flooded. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video.